Welcome to the What to Watch video update, where I'll go over some areas of the market that are looking more positive, and then I'll look over the areas that are looking negative because we're seeing some doubt really coming into the market. A lot of folks were really anticipating that the market would just automatically go up this time of year, especially the small caps and the mid caps, and they're doing the opposite right now. We're seeing some vulnerability to the market, but at the same time, we are seeing some potential setups that could turn into something positive, even though we're not really seeing any confirmation based on price. We're seeing some technical pictures come together that quite often will happen before we go up. But we want to be careful because there could still be more downside that could happen. This is being prepared for Monday, December 23rd. Before I get into that, we're coming up to the end of 2024. There's a thing called the SPX investing program. It's up, it's going, and it's free until the end of 2024. I will be locking it down in 2025. There are additional videos that I post there. You get early access to the videos as they are available. There's a course there that you can take. There's other courses that I will be rolling out. You can also set up times to speak with me and just see if that's something that's of interest to you. There's a link that'll take you to the website or to a video that talks more about the program. If you have any questions, please feel free to send me an email. Also, I do a number of different videos throughout the week, and this What to Watch video is the last video I do each week, but that is on the outside. All the different videos that I do all tie into the daily video. So the charts that you'll see in this particular video, I go through them day by day in the daily video. And I know the videos are a little longer, but we can see things developing and see them happen actually before they transpire into price action. And that's a really good way to get ahead of actually what's going on in the market. Okay, let's go through and look at the positive things. Now, as always with this video, just because it's on the positive side, there could be some negative things that we see in these charts. And then later on, when I get to the negative side of things, there's also some positive things that we could bring out there. And I'll try to point those out as we go through the different charts. First of all, we're looking pretty good here. This is an intraday chart of growth versus value, and we want growth to outperform when the market's going up. And it's still doing that. Even with the decline that we saw this week, growth is still hanging in there pretty well. If you go back to the end of November, that's when we started to see this overall trend higher on an intraday basis where growth was outperforming value. And value got hit pretty hard this week, and growth did as well. But even with the declines, we're still hanging in there pretty well. Another area is large cap growth versus large cap value. Also, we have the blue line above the red line. Now you see how the red line is really going down here and the blue line's been going up. That's more positive for the market, even though it did take a hit this past week. Looking at these moving averages. Now this is intermediate term. This is a rainbow chart. And the moving averages that you see here are from 50 periods up to 100 periods. And I usually show this chart in the deep dive video, but I wanted to show it here, where we're coming down and we're coming into the rainbow. And that's a concern. But for right now, this has happened pretty quickly. So the lines themselves are still continuing to go up. And everything is flowing up and to the right. If we can see a bounce out of this and get back above the rainbow, these lines will continue to go up. If we fall below the rainbow and stay below the rainbow, the lines will turn down. If we end up in the middle part of the rainbow, then the lines are going to start to turn all over each other and look more like spaghetti. But for right now, we're still at the higher end of the rainbow. In fact, we're right at the top of the rainbow as of Friday's close. Even though we dropped in the short term and we're negative in the short term, we closed right back up at the 50-day moving average in Friday's session. This is another look at the 50 period moving average where we're right back about at this level now. And this is intermediate term. Then, if we continue to fall, we will be watching the 100 period moving averages. Right now, these are still positive because price is above both the simple and exponential moving average. Then looking at the S&P 500, which is a weighted index, and then doing a ratio with the equal weight version of the S&P, We're still going up here, and that's positive because it's the large caps and the mega caps that really drive the indexes. And if this ratio continues to go up, that usually means the S&P will go up. And then, of course, the reverse of that is also true. So this going up should be taken as positive in the context where we're seeing it right now. We're also seeing discretionary holding up quite well when compared to staples. Discretionary has been the best performing sector going back to the big decline we had last August. And we do a ratio between discretionary, which is more growth area, and this includes Tesla and Amazon, and staples, which are more defensive. That's what the market gets into when they're afraid we're going down. Well, they've been getting hit as well. And when we do the ratio between the two, this is still looking pretty solid. The NASDAQ, even though it declined, it's still above its 50-day moving average. So in the short term, a little more negative there. But the fact that it's still above this blue line, which is a 50-period moving average, is seen as positive. The NASDAQ 100 also still above its 50-day moving average. And so these are the big mega cap stocks and tech stocks, and the market needs those to do well to really go higher. And so far, it's got hit with everything else, but still looking fairly positive at this point. We also look at growth to value for the small caps, even though if you look at the index, my gosh, yeah, here, the Santa rally. But we've been really going down with the small caps just at the index level. But if you look under the surface and you compare growth to value, this is really doing quite well. And we're seeing pretty much that same thing with the mid caps. Mid caps, the index, not looking very good by itself, but the growth to value ratio continues to go up, and that could be positive longer term. Then we look at a ratio of the QQQs, which is the NASDAQ 100, to the IWM, which is the Russell 2000 Small Cap Index. And we've been right around this blue line here, which is positive, and we're even breaking above that. And you can see way back in the year 2000, we came up to this high level and then just tanked after that. We've been able to maintain these high readings currently, and if this continues to go up, that would be more positive, meaning that the NASDAQ 100 continues to outperform the small caps. Total US stock ETF did drop down below its 50-day moving average, but was able to come right back up and close on that in Friday's session. The Wilshire 5000, the same thing, below its 50-day moving average, but coming back up. So the intermediate term is trying to hang on, and that's kind of where price is hanging out right now, is at the 50-day moving average for the different indexes. The financial sector, we're getting a little bit concerned here as we were seeing the financial sector coming down, but it also is starting to bounce up a little bit to its 50-day moving average. The FANG index, which earlier in the week set an all-time high, this is the big mega cap index, Facebook, Apple, Amazon, Netflix, Google, Nvidia, stocks like that, still well above its 50-day moving average, but it did get hit last week like everything else. We did come back down below this short-term trend line, but we're still above this longer-term trend line. So if we can go up and get back above this trend line, that would turn things even more positive. And we look at a ratio between the tech sector and 3 to 7 year bonds. Even with the week that we saw, we're still at the high end of this rainbow. We look at another ratio, the NASDAQ 100 to the Dow, also doing really well. Going back up with this ratio, showing that the NASDAQ 100 is outperforming the Dow. The weekly chart of the NASDAQ 100 still positive, even though it was down over 2% on the week. We look at another ratio, the QQQs, which is the NASDAQ 100 to 3 to 7 year bonds. It came down, but we're still at the high end of the rainbow. Then this is what the market, you can kind of use this as, are we going to go into a recession or are we not going to go into a recession? We're still at the high end of this rainbow here, and we've been going up. And that means that the market is anticipating a soft landing, which means no recession. If this continues to come down, that means the bonds are outperforming stocks and the market's getting more defensive. Then that would mean that the market is thinking we're going to go into a recession. But for right now, even though we're pulling back, it looks like the market assumes that we won't be heading into a recession. Then we look at growth to value here, a growth versus value ETF, doing quite well over here. This could be a positive setup going forward from here if growth can continue to outperform. The trend channel going back to 2009 for the S&P, It's a little bit of a concern because we came right up to this trend channel. That's where we topped out, and we've been coming down here. But if we turn around and are able to get back up to this trend line, that would, of course, be more positive. We're still above the midpoint here, which is positive, and we can go above the trend channel just like we saw back in 2021. This could also be taken as negative, meaning that we've hit overhead resistance and we'll be starting to come back down. We look at the growth to value ratios, the Qs to S&P, even though they're declining here, we look at the moving averages and they're continuing to go up here with the Qs to S&P, discretionary to S&P, and large cap growth to large cap value. Still seeing things really more positive under the surface when we look at the large caps, mid caps, and small caps and compare growth versus value there. Then here's an end of day chart looking at growth to value for the S&P. Even with the big decline this past week, this has still been going up. And the Qs were able to get back up to their 20 period moving average. They dropped down below that, never made it down to the 50, and now coming back up to this level. And so we're seeing a bit of a bounce here. Now, if we continue to fall, and especially if we fall below the 50-day moving average, that's going to turn it more negative. Large cap growth, even though it's off of its highs here, also still above this 50 period moving average here. We look at another ratio between large caps and small caps. When this is going up, that means the large caps are outperforming. And if you're in the S&P 500, you want this ratio to go up. Ichimoku cloud. This is positive in the fact that even though we've been declining, we're still at the high end of this green cloud here. Now we're seeing some vulnerability. There's a green line in here that has been coming down and it bounced up on Friday. That's shorter term. And if the blue line continues to go down and cross below the red line, that would turn things more negative as well. But if we can bounce up out of the cloud, have these lines turn back up, that will be more positive. Further deterioration here would turn this more negative. And then Tom Bowley did this. He's connected to stockcharts.com as well as earningsbeats.com. And this research was done over a year ago now when he broke it out and said, how do stocks perform depending on where we're at with the VIX, which measures fear in the market? When we're above 20, then we see negative annualized returns. And we spent a few days well above 20 this past week. But now we're dropping down and we ended up closing in the 18 range, and this is when we start to get back into positive annualized returns. So if the VIX can stay down and remain either where it's at right now or even drop lower, because that means fear is coming out of the market, that would be more positive for the market as well. So the reason this is positive is because we came back down under 20. Now we look at the negative side of things. We are pretty negative as far as sentiment. We've really declined here, but we've become extreme negative as far as sentiment, and we did bounce up a little bit on Friday. If we continue to go up with stocks, this will continue to go up as well and actually could turn more positive. But for right now, the overall context is that this has been declining. The VIX, which did come down and close under 20, but we spent a few days really high, higher than we've been here in quite some time. And so this is taken as negative, where we're above the moving averages here. When we drop below the moving averages, that's when we're a little more positive. And on top here is the line chart. That's the closing value for the VIX. And then there's a bar chart here. And both of these are still above the moving average. So that's treated more as negative until we go back up and the VIX continues to drop. This has been on the list now for quite some time, and I'm not quite sure whether to take this as positive or negative. The VIX is calculated by using at the money options. The skew index uses out of the money options, and we're still getting a very high reading here, meaning that the market is anticipating some kind of a big move. And even after the big downward move that we saw on Wednesday, this actually went up. So whatever move the market's expecting hasn't happened yet to drop this out of the red area. So we're not quite sure if this is positive or negative. So we use this in conjunction with our other sentiment studies like the VIX and just seeing how the market is feeling overall, that the market is still expecting something big to happen. The momentum of the VIX continues to go back up as we're going up with the VIX, and that's negative for stocks. The MACD is also going back up here. Now we are declining and we're back under 20. The MACD is rolling over a little bit, but it hasn't crossed below its moving average yet, so it's still negative. And internally, we're seeing weakness coming into the S&P 500. This is the new highs minus the new lows. We're seeing a more of an expansion of the red, that's lows, and a real contraction of the new highs. That's the green area here. And then we look at a 5 period and a 10 period moving average, and these are both continuing to go down. Now, on the positive side, we're getting down to a really extreme reading when we hit this red line here, and other times this can quite often mark some kind of a bottom in the market, but we don't know that yet. We can just look at this ahead of time and be ready for this, knowing that, okay, there's a nice looking setup right here. We just don't see it confirmed yet based on price. Also, the advanced decline line. Now, this is negative because we've been declining. It's also positive because we're still above this advancing moving average. And we saw a really strong upthrust day in Friday's session here, which could be positive. But because the overall context is that we're declining here, that's still negative. And I have a number of smart money indicators. This is one of them. It's called accumulation distribution. We're below the moving average, even though we did bounce up on Friday. We're going to have to get back above this red line, which is the moving average, in order for this to turn positive. And the advanced decline ratio had become extreme negative. That's based on 19 periods, but we're bouncing back up here. And we're also bouncing back up based on 39 periods, but the fact that we're still below zero is negative. And we look at the cumulative advanced decline line for the NYSE, it had been really dropping off, even though in Friday's session we had a really nice up move there. But when we look at the regular NYSE advanced decline line, we're still below the moving average. This is another NYSE advanced decline line that's calculated in a slightly different way, also still below the moving average here. That makes it more negative. And we're coming down here with common stock on the NYSE based on price and volume, even though we did see a nice little bounce in Friday's session. We want to know, can that continue? Is there going to be a follow-through bounce to what we saw in Friday's session there? And then the advanced decline line studies were negative here because we're below all the moving averages, even though we are starting to turn back up. We won't turn back positive until we cross back above the moving averages, specifically for the S&P 500. The short-term trend is now turned negative. We have the red line above the green line, so that's negative, and we're seeing this kind of going sideways a little bit here. It's still slightly above its moving average, and this suggests in the short term a strengthening trend that is now negative, where just a few days ago this was positive. Now the red line is coming down and the green line is coming up. If we see the green line continue to go up and the red line continue to go down, that would turn the trend back over to positive. But we haven't seen that yet. Here's the intermediate term trend, also still slightly above its moving average and above 20. So we are in a trending environment that's getting stronger. And we did see a cross here with the red line crossing above the green line, but the red line's coming down as the green line's going up. And that could be positive, but it hasn't turned positive yet. Looking at the moving averages just on the S&P 500 itself, getting extreme negative with the 20, but starting to turn up, which could be positive. We also became extreme with the 50-period moving average and also starting to turn up there. And we're declining and showing a little bit of an improvement here with the 200-period moving average. But overall, the decline here treats this as negative. And we're below the short-term moving average, 20 periods. We had been holding out above the simple and exponential moving averages for quite some time here. And even though we were chopping sideways, we were still above the moving averages. That all changed on Wednesday. We sliced down through the 20-period moving averages. That's turned the short term to negative. And here's another short-term rainbow where we went from the top end of the rainbow and actually being above the rainbow to now being below the rainbow. We need this to get back up here. The lines haven't started to roll over yet, but the longer we stay below the rainbow or in the rainbow, the more spaghetti-like these lines are going to look. Look at the S&P McClellan oscillator, and this is one of the potential positive setups here. we're getting a very extreme negative reading here. So this is negative in and of itself, but we're starting to bounce back up here. And if you notice, other times when we bounced, it actually bottomed and started to go back up before we saw that with price. That could be interesting, but we're not seeing it really based on price yet. Even when we didn't have such an extreme reading, if you pair up the low reading that we had here back in August, this actually bottomed before we saw a bottom in price, and then price went up after that. We're watching this to see. This could be negative right now, but it could turn into something positive if we continue to go up with the McClellan oscillator and price starts to go back up. Then when the McClellan oscillator is negative, that makes the summation index negative, and we're still declining and we're going below zero based on price. We're well below zero here based on volume. So this chart is more negative. This is slower, but it gets its value from the previous chart, the S&P McClellan oscillator. Anytime this is below zero, the summation index goes down. It's negative. Then we look at the NYSE McClellan oscillator, also getting a very, very low reading here, but starting to bounce back up. We'll have to see if this can continue to go up. That might be that a bottom is in place here, but we have no confirmation of that yet based on price, even though Friday was a good start to all of that. So, like the other one, when the McClellan oscillator for the NYSE is negative, the summation index based on price and volume continued to go down. Where the McClellan oscillator is more short term, somewhat intermediate term, the summation index is a little bit intermediate term to even somewhat long term. Then the Swenlin trading oscillator, this could be positive, but right now the overall context is that we've been going down, so it's negative, but we're starting to see this turn back up. If it can continue, that could be a positive setup for the S&P. Now we have had false signals from this indicator before, so you don't want to front run this. You want to use other charts, bring them together and reach a consensus. Are we seeing some improvement? And yeah, we are. We're just not seeing it yet really based on price. We're going to have a good solid Monday for this to continue to look more positive. Now, on the negative side, we have turned negative with the parabolic SAR. When the dots are on top, that's negative. And another thing that is quite negative here is that the weekly chart, we now have a dot on top with the parabolic SAR. The market's going to have to overcome this to turn back more positive. On a momentum basis, we're negative, and I have two short-term oscillators here that are going down. I have three intermediate-term oscillators. They're also going down, and even the longer-term oscillators are going down as well. This is quite negative currently. We're below the 20-period moving averages. We're right at the 50-period moving averages. If this can hold and we go up from here, that would be positive. If we start to break lower and head towards the 100-period moving averages, that's going to be quite a bit more negative. And we're still negative here. The bullish percent index, measuring the point and figure buyer sell signals inside the S&P, this continues to go down. And that means there's more sell signals inside the S&P. We dropped below 50 and we're still falling here. So this is negative. Also dropping below 50 with the NYSE bullish percent index. And we had been hanging out at a really high level with the NASDAQ 100 bullish percent index. Well, that kind of fell off a cliff. Even though the NASDAQ 100 has been holding up better, but we still dropped below 50 and we're declining. Chicken money flow, another smart money indicator. We're below zero, even though we ticked up a little bit with the red histogram here, but the red line's continuing to go down. So this is still negative also. And the Chaikin oscillator ticked up a little bit on Friday, but still continues to decline. So we have three of our smart money indicators that are all negative for right now. The vortex, which had been positive, is now switched over to negative this past week with the red line going above the green line. And we look at the advanced decline line for the S&P based on price. We ticked up here based on price and volume, but we still have been declining overall. And then those stocks inside the S&P that are above their 20-period moving averages, okay, getting a really extreme negative reading, but starting to turn up. And you can see sometimes we bottom with this before price ends up bottoming. Now, we don't see confirmation of that yet. We don't want to jump in saying, oh, look at all this. But we are seeing a convergence of some potential setup signals with the McClellan oscillator and here with the 20-period moving averages. Now, on the next chart, this is what we want to watch here. We're getting a reading below 10, and we start to come up. Now, what needs to happen fairly quickly over the next few trading sessions is we want to go from this green line all the way up to above 70. That means good short-term upward thrust momentum there. But we don't want to get faked out either, because if this doesn't go all the way up to 70, yeah, it was improving, but then we ended up making an even lower low based on price. And this happened back in October of 2023. But if we do get a nice signal here with a low reading and then get up above 70, look at what the S&P did after that. So we'll be watching this to see if it's turning into something more positive. But right now it's clearly negative. We're also seeing a bounce up here after getting a real extreme reading with the stocks inside the S&P above their 50-day moving average and turning back up, but still below 50 and negative with the 100 period moving average steady. We're still above 50 here, so that could be treated as positive and bouncing back up. But I like to keep these charts together, and this measures the 200-day moving average. All right, then the Dow is negative because it dropped down below its 50-day moving average, but it did bounce up enough in Friday's session to get back about above this S1 pivot point. The momentum for the Nasdaq 100 is still negative. Small caps, yeah, supposed to automatically just go up here. Not doing that right now. Coming back up to this S1 pivot point, and we close just below that. If we can get back above the 50-day moving average and above this pivot point, that would turn things more negative. But right now, this is quite positive. Excuse me. This is quite negative here. It would turn more positive. Then we look at another small cap index, the Russell 2000. Now, this is negative because the RSI is down, but it's starting to go back up and it's an extreme negative reading. We're negative here because we're below the 50-day moving average, but this is still positive because we're above the 200-day moving average, but the momentum as measured by the MACD continues to be down. Look at a ratio between small caps and the S&P. When this is going down, that continues to show that the small caps are underperforming. Mid caps also below their 50-day moving average, below this S1 pivot point, did bounce up in Friday's session, but we've got a lot of damage to repair to turn back and look more positive. And the bank ETF, where we've just been trailing off here and actually dropping below its 50-day moving average, even though the longer term trend for this is still positive. And what's causing a lot of concern is that the 10-year yield is going back up, and that's having more of an impact. It did drop in Friday's session. That's why we saw a nice little bounce, but we need interest rates to keep coming back down. Instead, they've been going back up. This is also a bit of a concern. Home construction to the 3 to 7 year bonds. When this happened before, we came down to the 250 period moving average and we were able to bounce up off of that. And then that happened earlier in 2024 and we bounced up off of that. This time we're falling below the rainbow, and that's causing a bit more concern right now. Then we look at the Amex, NASDAQ, and NYSE and take a 5 period moving average of the highs minus the lows. We're below zero. So that's broader market negative and a little bit longer term. Also, even a little bit longer term of the highs and lows for the S&P. We're falling below 50 here. That's negative. Now, this is negative, but could end up being positive, but we have to see this follow through here. This is the ZWAG NYSE breadth thrust, and we're getting a very low reading here. Now, at some point, if we bottom out, and unfortunately, there's a 1 day lag with the day, how this chart is updated. So this is for the 19th, which was Thursday. We won't get Friday's data until after Monday. But we're getting a very low reading here, which, yeah, that's negative, and it's below 0.4. And Marty Zwag, who developed this decades ago, he's since passed away. It's one of the first books I read when I was learning about the stock market in the early 90s. This is research that he did. Now, what can happen is if we start to turn and go back up and we go from this zero point 0.4 level to this red line in 10 trading days, which would be 10 weeks, that's called a ZWAG NYSE breadth thrust. And other times when this happened, look at what the S&P did after that. Then we had another one. Look at what the S&P did after that. So we're not there yet, but we're waiting to see because we don't know how much this has to work it out. And we don't even know for sure if we're even going to get up to this red line. But this is potentially positive, but right now the context is that it's negative. And then some different areas that I'm watching, which usually are not positive or negative. In fact, there's some that are positive and negative at the same time, and I'll explain that. We just keep an eye on jobless claims, which come out every Thursday. They've been starting to go back up, even though we saw a decline in the latest reading. I follow mainly the 4-week moving average here. We also keep an eye on continuing claims, which are still continuing to come down, and that means the employment situation is improving or at least holding up for the time being. We keep an eye on the dollar, which is in an uptrend, and the stock market likes a weaker dollar. And the fact that this is in an uptrend has been pressuring stocks. This is one chart that's negative. This is the SOX index, which measures semiconductors. And you can see here we've seen a recent death cross with the blue line crossing below the red line and prices below both of the lines. That's negative. Then we look at a ratio between the semiconductors and the Dow, and this isn't as weak as it had been, but the fact that we're not up to this blue line and we're actually declining, that treats this ratio as more negative. And we look at another ratio between the semiconductors and the tech sector. Semis are part of the tech sector. Earlier in 2024, this ratio was going up, and that was quite positive. Now we've been going down. Now, a week ago, we had a good day on Friday and Monday previous week, and we were starting to go back up. Well, now we're starting to go back down. And so there's a positive side to this in that we had been improving. The negative part of this is that now we're going back down with this ratio. We need this ratio to go up for it to be positive. But then when you look at this chart, we're still above the 200-day moving average here, and we're still in an uptrend, even though it's not all that strong. This is the SMH Semiconductor ETF, and this is what a lot of folks may be using to actually key off of. Because see, other times we came down to the 200-day moving average, we might have fallen a little bit below it, but we were able to hold out and bounce up off of it, bounce up off of the moving average. Are we going to be able to do that this time? If we break more to the downside, that's going to turn things more negative. And here's a rainbow look at that, where earlier on in 2024, this was really outperforming and really doing quite well. And then it's just been going sideways ever since. And that's where we saw the mega caps and tech stocks starting to lag as the rest of the market was showing some improvement. We would like this to turn and go up above the rainbow to be more positive. And then looking at the seasonality of it all, we go from the Tuesday before Thanksgiving. Now we're kind of right in the middle of this whole thing to the second day of the new year, where we're up 79.73% of the time with the S&P. We're up almost 78% with the small caps. Not really seeing much of that yet, although the S&P's been doing well. The small caps are going in the opposite direction currently. But this could still feed into the positive seasonality. We're still in that window for this to happen. And then this is Stock Trader's Almanac chart. This is looking out from the 23rd Monday going into the rest of the year, where we often see positive seasonality. The green dashed line is the S&P 500. The red dashed line are the small caps. So, but they probably should have kicked into gear already, and they're not. They're going down. So we'll have to see. Now, there's nothing automatic about any of this. We just use seasonality as a guide, realizing that it doesn't always happen that way 100% of the time. And then we have this thing called the Hindenburg Omen. And if you want to pause this and read, there's 3 conditions that have to be met. The perma bears, even if we're close to one of these conditions, they declare it as a real thing, where I like to be a little bit more disciplined with that. And here is the chart. And we did get a confirmation signal this past week. This spiked up. And it happened before December 19th. So we'll have to see. Are we going to get more spikes after this? Now, the more spikes we get, the more dangerous it will be, because right here we saw a series of spikes, and this was right before the COVID crash. And then at the end of 2021, we saw a number of spikes here. And then we went into 2022. Well, we're waiting to see what's going to happen here. So thank you. I really hope you found this helpful. Have a great weekend. If you don't watch any more of my videos, Merry Christmas, and I will talk to you in the next video.